Welcome back to Investing Talk Podcast. We're here to cut through the noise and give you clear, actionable insights into the markets. Today, we're diving into a question many of you have sent in. Is BigBear.ai, is it a good time to buy now? We've pulled together a comprehensive stock analysis and, recent company news to explore the current landscape for BigBear.ai. We're looking at everything from its financial health and market position to, potential future catalysts. Our goal is really to arm you with the knowledge to thoroughly consider this investment opportunity for yourselves. Before we get into all those details, though, if you find this discussion valuable, please remember to hit subscribe, like, and leave us a comment. It genuinely helps us continue bringing you these in-depth analyses. And if you're feeling generous, you can always consider buying us a coffee. Also, if there's a specific company you'd like us to look into next, just drop a comment below and let us know. Okay, let's unpack this. So to start, for those unfamiliar, what exactly is BigBear.ai? This isn't your average consumer tech company. They operate in some truly specialized and critical sectors, right?
Precisely. Yeah, BigBear.ai positions itself as a provider of AI-powered decision intelligence solutions. What's particularly compelling about them is their very strong presence in U.S. defense, security, and enterprise markets. They're involved in crucial areas like homeland and border security, defense, and intelligence. Think about helping government agencies safeguard borders, improve operational efficiency, and provide real-time predictive capabilities in high-stakes environments. It's about leveraging artificial intelligence to make sense of complex data and inform critical decisions, often when seconds count.
It sounds like they're building some really advanced tools for very specific and demanding clients. Can you give us a clearer sense of the specific types of solutions they offer? What does that really look like on the ground?
Absolutely. So their solutions cover a pretty broad spectrum of cutting-edge AI applications. For example, they offer AI orchestration and sensor fusion. Imagine a scenario in defense where you have data streaming in from hundreds of different sources simultaneously. Drones, satellites, ground sensors, human intelligence. It's just a flood of information, right?
Yeah, overwhelming.
Exactly. So AI orchestration is designed to untangle all that, to fuse disparate data points and give commanders a single, coherent, real-time operational picture. It transforms raw data into immediate, actionable intelligence, which is frankly a massive leap forward for operational speed and safety. Then there's cybersecurity, where they use AI for proactive threat detection and mitigation. They also provide predictive intelligence for mission delivery and digital transformation, which is really about anticipating needs and outcomes before they happen. They heavily utilize modeling and simulation, often with what's called digital twin technology.
Digital twins, right.
Yeah, for those who might not be familiar, a digital twin is essentially a perfect virtual replica of a physical system, process, or even an entire environment. AI then uses this digital twin to run simulations, predict potential failures, or test various scenarios without ever touching the real thing. It's incredibly powerful for rapid course of action analysis in critical situations. And finally, they're involved in digital identity management through facial recognition and biometric matching, and computer vision for enhanced monitoring and threat detection. These are all high-impact, cutting-edge areas, often tailored for very specific, high-stakes environments where reliability and accuracy are paramount.
That's a great breakdown of their capabilities. So we understand what they do, but the real question for investors is, how are they doing? Let's peel back the layers on their latest financials, specifically looking at their Q2 2025 results. What's the story there?
Okay, yeah. If we connect this to the bigger picture, their Q2 2025 results do show some significant points of strength. BigBear.ai reported a record cash balance of $390.8 million. To put that in perspective for you, that's substantially stronger than prior quarters and provides a very healthy cushion.
That's a lot of cash.
It is. They also projected full-year 2025 revenue of $125 million to $140 million, indicating sequential improvement. This suggests management is clearly focused on growth and is leveraging opportunities in the burgeoning government AI spending. We've seen considerable federal funding allocated to agencies integral to their markets, especially after what many in the industry call the One Big Beautiful Bill.
A record cash balance and growing revenue certainly sounds promising, especially in a sector as hot as AI. But with high-growth tech, revenue can sometimes mask deeper operational costs. What's the real story behind that revenue growth? And perhaps more importantly, what about profitability? This is often where it gets, truly interesting for investors.
That's a critical question, absolutely. And it's where the financial picture becomes more nuanced. While the revenue outlook is positive and the cash position is undeniably strong, the report highlights a key challenge. BigBear.ai has a history of limited or negative earnings.
Ah,
This means they haven't consistently turned a profit. Consequently, traditional valuation metrics like the price earnings or PE ratio, they aren't really meaningful right now because there's often no earnings or negative earnings to base it on. The market appears to be pricing the company cautiously, clearly awaiting clearer and frankly more consistent signs of profitability and successful contract execution. It's a classic show-me situation.
right, a show-me situation. So if the PE ratio isn't telling us much because of that profitability challenge, what other valuation metrics should we be looking at? How do we understand how the market currently views BigBear.ai? What's the market's proxy for value here?
Well, in cases like this, we often turn to metrics that don't rely on earnings, like the price sales or PS ratio. As of August 27, 2025, using a $64 million market value and their projected $130 million in 2025 revenue, their PS ratio is approximately 0.5.
0.5, wow.
Yeah. And to put that into perspective for you, the broader AI sector often sees PS ratios of 5 or even more for high-growth names.
That's a huge gap.
It's a massive gap. This significant difference indicates the market is essentially saying, look, we're not buying the growth story yet. We see continued losses or a significant amount of risk here. Furthermore, with such a large cash position, their price-book ratio, which compares the company's market value to the value of its assets on the books, would likely be near or below 1. This is another indicator that the market might be valuing their current tangible assets, but not necessarily giving much credit to their future earning potential or the intangible value of their AI technology. It suggests a strong degree of skepticism.
That strong skepticism, despite their cash and revenue potential, is quite telling. Is that simply market apprehension about future profitability, or does it hint at something deeper? Are investors perhaps worried about their ability to actually convert that strong cash position into sustainable, high-margin government contracts, especially in such a competitive space?
You've hit on a crucial point there. It's not just about profitability, it's about the path to it and the sustainability of that path. The market is definitely awaiting stronger signals of consistent profitability and successful large-scale contract execution. It implies that while the underlying potential in their technology and market segment is certainly there, the market wants to see more tangible, consistent results before valuing them at those higher multiples typically seen in the AI space. It's a show-me market, like we said, especially for companies that haven't consistently delivered earnings, regardless of how promising their tech or market tailwinds might be. They're competing in a shark tank, really, and investors want proof they can swim.
Speaking of that shark tank, every investment comes with risks. And BigBear.ai's competitive landscape sounds incredibly intense. What should we be aware of on that front? Who are they up against, and what are the specific challenges?
Yeah, BigBear.ai operates in intensely competitive sectors. They're facing major players with significantly deeper resources, names like Palantir and other well-established AI-focused defense contractors. This raises an important question for you, the investor. Can they effectively compete? Can they secure enough large-scale, high-value contracts against these formidable competitors? Their success hinges heavily on their ability to differentiate their offerings and execute flawlessly in this very crowded space. Imagine being a smaller, nimble challenger trying to carve out market share against giants who have long-standing relationships and, frankly, vast budgets. It's an uphill battle. It requires constant innovation and strategic prowess.
Absolutely. Beyond the competitive pressures, what are some of the other stock-specific and broader market risks that jump out from the analysis? What are the potential landmines here for investors?
Well, the latest filings highlight several. Stock-specific risks primarily revolve around their heavy reliance on government contracts,
Right.
which means their fortunes can fluctuate significantly with federal budget cycles, political priorities, even changes in administration. There's also the issue of customer concentration, where maybe just a few large contracts can disproportionately impact their revenue.
Yeah.
Any volatility in AI project funding or execution delays could materially impact their performance. And as we discussed, their uncertain profitability remains a key concern.
Okay.
From a broader market perspective, the AI and defense tech sectors are highly susceptible to rapid technological shifts. What's cutting edge today could be, well, outdated tomorrow. There are also macroeconomic downturns to consider. As a small-cap stock, BigBear.ai also faces potential liquidity risks and outsized volatility during such periods. It's a high-growth, high-reward, but also, high-risk environment.
Definitely sounds like it. Beyond the financials and inherent risks, there's always the news flow to consider. What's been happening recently with BigBear.ai that could influence its trajectory? And what strategic moves are they making?
One interesting development that definitely caught our eye is the multi-year partnership with the Washington Commanders, announced back on August 20th, 2025. BigBear.ai is now the naming rights partner for the Commanders training facility, which has been renamed the BigBear.ai Performance Center.
Oh, wow.
Yeah, and their branding will also be featured across the Northwest Stadium and on the team's practice jerseys. This is quite a significant move into mainstream visibility for a company that, let's face it, often operates largely behind the scenes in government and defense circles.
So from safeguarding borders and analyzing intelligence to sponsoring an NFL team, that's quite the brand leap. It almost feels like a specialized tech company suddenly buying a Super Bowl ad. What did the companies say about this partnership, and what does this going on offense really signify for their core business strategy? Is it just marketing fluff?
Well, Kevin McAleenan, BigBear.ai's CEO, was quite clear about it. He stated, BigBear.ai is going on offense, and this partnership exemplifies our strategy. We're stepping onto the national stage with one of the NFL's most recognized franchises. He views it as the first in a series of decisive moves to strengthen their position and unlock growth. So, while it won't directly win them a Department of Defense contract, it's about broader brand recognition. Definitely. It's about attracting top talent in a brutally competitive market, and perhaps even signaling their intent to expand into more commercial enterprise opportunities beyond their traditional government focus. It's a long game and a very public one.
That's a fascinating play. Okay, what about other short-term and long-term catalysts that we should be watching for? What are the upcoming milestones that could potentially move the needle?
Short term, the next scheduled Q3 2025 earnings report is crucial. Any further guidance or updates on their contract pipeline, particularly related to new Department of Homeland Security and Defense allocations, that could certainly move the stock. You'll want to pay close attention to any new contract announcements. Long term, you want to watch for their sustained execution on those large-scale government AI contracts. Are they delivering on time and on budget? Are those contracts actually translating into profitable revenue streams? That's key. Also, keep an eye out for any strategic partnerships or maybe mergers and acquisitions activity in the AI or defense sectors. Those could signal significant shifts or expansions for the company. These are the factors that will ultimately determine their sustainable growth and, crucially, profitability.
Right, the execution piece again. Now, insider activity often gives us a peek into how those closest to the company feel about its future. What did our sources reveal about that? Are company executives buying or selling shares?
Yeah, there was a Form 144 filing from August 27, 2025 that did indicate a proposed insider sale of just under 12,000 common shares. Now, while this signals some cashing out, the insider also declared they were unaware of any undisclosed material adverse information, which is, fairly standard legal representation. It's worth noting that other insider ownership changes haven't shown a systemic pattern of large buys or sales recently. This suggests there isn't a massive wave of insiders abandoning ship, but it's also not a strong signal of conviction through large-scale buying either. It's more of a, let's say, a neutral signal overall, maybe a bit of profit-taking, but no mass exodus.
Okay, so not a strong signal either way there. Bringing all these threads together then, what does this all mean for someone considering BigBear.ai right now? If you had to give an overall assessment, how would you sum up the investment thesis here? What's the bottom line?
Well, the overall rating from our analysis is the 4 out of 10.
4 out of 10, okay.
Yeah. Look, BigBear.ai is fundamentally stronger than it was in prior years, with that record cash balance and improved revenue guidance. That's positive. It also stands to benefit significantly from a surge in federal AI and defense investment, which is a powerful tailwind, no doubt. However, the consistent lack of profitability, the intensely high sectoral risk, those low valuation multiples reflecting market skepticism, and the ongoing insider sales, all that tempers enthusiasm for both short-term and long-term positions. It's a situation where the potential is clear, but the execution risk and the profitability timeline are major question marks. Ultimately, it seems best suited for high-risk, short-term trading around specific news and contract announcements, rather than an attractive long-term investment at this point. That assessment holds until profit visibility and consistent, successful execution on those critical government contracts materially improve. You're essentially betting on future potential rather than current demonstrated performance.
That's a comprehensive and very candid look at BigBear.ai. It seems like a company with, yes, significant potential operating in a critical and growing sector, but one also battling notable challenges, particularly around profitability and that intense competition. The question, is BigBear.ai a good time to buy now? Really comes down to your personal risk tolerance and investment horizon, doesn't it? Are you a high-risk trader looking for short-term opportunities around news events, or are you a more conservative investor waiting for clearer signs of sustainable profitability?
Exactly. And what's truly fascinating here, I think, is how a company can have such strong fundamental tailwinds from government spending and these significant new marketing partnerships, yet still be viewed with such caution by the market due to its earnings profile. It really raises an important question for you, the listener. How much faith do you place in future growth stories versus current profitability, especially in a rapidly evolving high-stakes sector like AI?
A powerful question indeed, something to reflect on as you consider your next steps. That's all for this Investing Talk podcast. We hope this exploration has been valuable. Until next time.